Hello and welcome to this second section on the introduction to the financial system. In this section we are going to look at what the financial system is all about, building on the last chapter where we looked at what finance is all about. So what is the financial system and what are the components of the financial system? That should be the takeaway in this lesson. Now, we know the definition of a system. Usually a system is composed of several components. A system is composed of several components that come together to achieve a given objective. For example, in biology we have the circulatory system, which consists of the heart, the capillaries, and the others, that make sure the blood moves around the body the way it should. We have systems. For example, when you have ERP systems, an ERP system, this is a computer system that is made up of the physical hardware, the software, the people that come together to ensure adequate management of institutions. So a system, in a nutshell, is made up of several components, and these components come together to achieve a given objective. Remember, we said in finance, we do have several objectives. One of the objectives and one of the functions of finance is providing a way for us to make payments. When you go to a shop, how can you make that payment? You know, you can use cash, you can use your phone, M-Pesa, you can use your card, that is your ATM card, and so on. So this is the financial system in action. So what are the pillars of the financial system? So any financial system is made up of three components: financial assets, financial institutions, and regulators. We can look at each one of them in turns. Financial assets, we define them as claims to future payments. These are claims to future payments. That may sound very abstract. You may not understand it. What we mean is that when you hold a financial asset, you can use it to claim some payment in future. For example, when you hold shares in a company, when you own shares in a company, in the future, you can go there and claim a share of the profit, which is called dividends. In the case the company is being wound up, you can always claim a portion of the assets. So financial assets are very different from real assets. Remember, real assets, they are things like land, housing, the property, plant and equipment that we have around there, your furniture at home. Those are real assets. They are the ones that are directly used in production. However, financial assets, they are simply claims to future payments. What are the examples of financial assets? The most prominent financial asset is cash, money. When you have money in your pocket now, you know that come lunchtime, you can walk into any hotel and order food. That is a kind of a payment. You can give them your money, then they pay you in the form of food. You can go to any supermarket, buy whatever you want. So the most important financial asset and the most prominent is cash, money. Number two, we have shares. These represent partial ownership of a corporation. When you are a shareholder in a company, it means you own part of that company. We have bonds, B-O-N-D, bonds. When you hold a bond, ideally what you are doing, you are lending your money. You are lending your money to that other entity. So for shareholders, you get dividends. For For bondholders, you are paid interest. We have many other types of financial assets that we are going to look at. The second component of the financial system is what we call financial institutions. Financial institutions are divided into two parts. We have what we call financial intermediaries. Think of financial intermediaries as institutions such as commercial banks, insurance companies, credit reference bureaus, foreign exchange bureaus, microfinance institutions, SACCOs. This is where you deposit your money. In many cases, you deposit your money there, and you can always get it later. And what will the financial intermediaries do? When you deposit your money into the bank, what the bank does, it is not going to sit on that money. It is going to take that money and lend it out to other people. So ideally, when you deposit money in a bank, you are lending that money to other people indirectly. Instead of lending the money to people directly, you lend it to them through the bank. We are going to see why the bank is at a better position to lend out money to individuals other than you yourself lending money to people that you may not even know. So the first component of financial institutions is financial intermediaries. The other component is what we call financial markets. Financial markets is the whole of any physical or virtual location where financial assets are traded. We said financial assets include things like money, shares, and bonds. Where are they traded? You can go to the Nairobi Securities Exchange, buy shares. That is a financial market. You can go to the bank with your dollars and you exchange them for Kenya shillings. Again, that is a financial market because that is a place where you are exchanging currencies. So financial institutions, they are composed of those two components, financial intermediaries and financial markets. The last component are the regulators. Every financial system in every country in the world has a regulatory framework. People who set rules and ensure that those rules are adhered to. In Kenya, for example, every bank is regulated by the Central Bank of Kenya. We are talking about the commercial banks. Every insurance company is regulated by an organization that we call the Insurance Regulatory Authority. Every pension scheme is regulated by an organization called the Retirement Benefits Authority. So on and so on. So those are the three components of the financial system. Now we can go through them, giving examples. We talked about financial assets and what they are. This is the first component. And we give examples. Money is a financial asset. Stocks or equities or shares, you'll hear people talk about them. They are financial assets. Bonds. When you buy a bond, essentially you are lending money to a corporation. So in the case of stocks, you get dividends. In the case of bonds, you get interest or coupon. This term here, this one means interest. We have foreign exchange. When you hold dollars, you can always convert the dollars to Kenya shillings. And lastly, we have what we call securitized loans. These are examples of financial assets. I think we have discussed them in more detail as we were talking about them there. So I want you to go into the details of these notes and look at what stocks are, what bonds are, also, we can look at foreign exchange and securitized loans. Foreign exchange, think of it as foreign money that you hold. If you have 100, if your friend sends you $100 or you work online and you are paid $100, that is an example of what we are talking about, foreign exchange. You can always convert that dollar that you hold into Kenya shillings. So again, foreign exchange is an example of a financial asset. Securitized loans, this one may be a bit complex. We can convert loans into financial assets, into shares, something of sort, using a process called securitization. So securitization is a process where bank loans are converted to tradable financial assets. We are going to look at those matters in more details in the future. Now, the next component of the financial system are financial intermediaries. We said financial intermediaries act as a go-between lenders and borrowers. When you have excess money, you deposit it in a bank. Then the bank is going to lend that money to other people who have a shortage. That is an example of intermediation. Think of an intermediary as a broker, a go-between. So we have many examples of financial intermediaries, including commercial banks, microfinance institutions, SACCOs, insurance companies, pension funds, investment banks, and so on and so on. There are so many of them. And financial intermediaries engage in what we call indirect finance. They take money from you, then they lend that money to somebody else. You can see they are taking your money and lending it to somebody else. That is an example of indirect finance, as opposed to you yourself taking your own money and lending it to somebody else. We have direct finance. Direct finance is a case where you take money and you lend it to somebody direct. Think of yourself lending money to your friend. That is direct finance. It is you to them, straight on. So that is an example of that. So all financial intermediaries down here, they engage in what we call indirect finance. They take your money, put it in the account, they take your money, lend it out. That is indirect. In the financial markets, on the other hand, this is what we call direct finance. Notice, think of a market. When you go to Karatina market, you know the market, it doesn't have its own goods. A market is simply a place where buyers and sellers meet and exchange their goods directly. Think of Karatina market or Getondoti market. A market doesn't have goods of its own. A market is simply a venue where you meet and exchange your goods directly. So in the financial market, what happens is what we call direct finance. The same thing happens when you lend money to your friend. That is direct finance because it is from your pocket to their pocket. So that is very, very critical for you to note. I'm not going to look at the role of commercial banks in details, but of course you should know what commercial banks do. They are the most prominent types of financial intermediaries, commercial banks. You can deposit your money there, you can apply for a loan. If you have variable assets like your title deeds and your certificates, you can deposit them in the bank, they can keep it for you securely, and so on and so on. So those are examples of what commercial banks do. Beyond commercial banks, we have other types of financial intermediaries. We have just said that commercial banks are the most prominent financial intermediaries. However, there are many others. I have already mentioned them. Insurance companies, pension funds, mutual funds. These are basically investment companies, hedge funds, investment banks, and other institutions like forex bureaus, building societies, SACCOs, and so on and so on. So far, what have we looked at? So far, we have looked at financial assets. We have looked at financial institutions. And we have said financial assets are those assets that give you a claim to future payments, like money, like foreign exchange, like shares, like bonds, like securitized loans. We have talked about financial institutions, which are divided into two. Financial intermediaries, like commercial banks, insurance companies, and the others. Then we have financial markets. Examples of financial markets include the Nairobi Securities Exchange, over-the-counter markets like the foreign exchange market. We are going to look at them in more details. Lastly, we are going to look at the regulators. In Kenya, it is the government that does most of the regulation. It is the government that does most of the regulation. And we have to be careful to know how much is too much regulation, how much is too little regulation. The key regulators in Kenya are the Central Bank of Kenya. This is a regulator that is in charge of commercial banks, a section of SACCOs, a section of mobile money payments, and so on. We have Insurance Regulatory Authority, IRA. This is a regulatory body. It is a government body that is in charge of insurance sector. Capital Markets Authority, CMA, is a government organ that also regulates the capital markets. Retirement Benefits Authority is in charge of pension funds and other retirement schemes. Then we have the Circle Societies Regulatory Authority, SASRA. This is also a government body that is in charge of regulating circles. This list may not be exhaustive. We are going to see there are some gaps and some overlaps here and there. But by and large, if you are able to know what each one of these ones does, you'll have at least a general picture of how regulation of the financial system is done in Kenya. So what does the financial system do? The financial system engages in what we call risk sharing. Think of insurance. When I get my vehicle, I insure it probably for 50,000 shillings and the vehicle is worth 2 million shillings. So what is happening here? I'm insuring my vehicle at 50,000 per year, but in case of anything, I'll be paid 2 million shillings. The idea is we are sharing risks. I'm not the only one person paying 50,000. Probably we are 10,000 of us. When 10,000 people pay 50,000 each, I think that will be 50 million. But you realize not all of us are going to have accidents. Not all of us are going to claim to be paid in case of anything. So probably 10 people will lose their vehicles. They'll be paid 2 million each, that is 20 million, and the insurance company is left with the other 50 million. So what we are doing essentially, we are sharing risks. We are sharing risks. So also the idea of diversification is a question of sharing risk. When you buy shares in a company, it is less risky than you owning a company all by yourself. Why? Because you can own a small proportion of Safaricom. Maybe you have 100 shares in Safaricom, you have 100 shares in Airtel, 100 shares in KCB, 100 shares there. By not putting all your eggs in one basket, you are reducing your risk. So the financial system allows you to reduce your risk by sharing it out, by diversifying your investments. Liquidity, this one should be pretty obvious. If I have land, and you have shares, and we happen to have an emergency, who is likely to convert their asset more quickly into cash? Mostly, the person who holds financial assets is able to very, very quickly convert them into cash. If I have shares, I can make an order to sell today. Today, let's say it's Wednesday, and by Friday, I'll have my money in the account. Information. The financial system collects a lot of information. You'll be surprised. A company like your bank, they know more about you more than you know yourself. They know how you spend, they know all your incomes, they know where you spend your money, because mostly if you use even the phone, they know where you are making those payments. They know what kinds of goods you like buying. So they have a lot of information about you. And that is why you as an individual, you cannot stand at the gate, at the university gate, and start lending out money to people you don't even know. But a bank is capable of doing that because they have been collecting this information they know this person very well. They know that this person went to KCB, borrowed some money, refused to pay. Remember, we have the CRB issue nowadays, the credit reference bureaus, which, by the way, I did not mention, is part of financial intermediaries, credit reference bureaus. So, in a nutshell, what we are saying, the financial system is able to collect a lot of information about potential borrowers. And that way, they are in a better position to make a judgment on who to lend money to, whom not to lend money to. We have payment services. This is very, very critical. Think of yourself. Without the financial system, how would you be making your payments? Mostly would be using barter trade, which was not very convenient. But nowadays, you have a whole range of ways of making payments. You can use your ATM, you can use cash, you can use your phone, you can write a check, you can use Bitcoin, so many things, so many ways of making payments. Why? Because of the financial system. Finally, they do what we call financial intermediation. That is, they act as a go-between between those people who have a shortage of cash and those people who have excess. When I have excess cash, I deposit it in the bank or in my M-Pesa account. Then that money will be taken by that bank and it is going to be lent out to other people who have a shortage of cash. Think of Furiza and the other things that we all do. That is an example of financial intermediation. Taking money to those who have money from those who have excess, lending it out to those people who have a shortage. So in a nutshell, that is what the financial system is all about. To link up, we have said the financial system is made up of three components: financial assets, just to give examples, not commercial banks, it is money, cash money, shares in a company, bonds, foreign exchange, securitized loans, and many others. That list I'm giving is not exhaustive. When you hold a financial asset, you can always claim future payments. When you hold cash, you can go to a hotel, ask for food. That food is a kind of a payment. When you hold a share in a company, by the end of the year you'll get a dividend. When you hold a bond, by the end of the year you can claim interest, and so on. We have financial institutions which are divided into two: financial intermediaries like commercial banks, insurance companies, microfinance institutions, credit reference bureaus. These ones, people fear them very much, CRB. Credit reference bureaus, SACCOs, pension funds, mutual funds, and so on and so on. There are so many. Then we have financial markets, like the Nairobi Securities Exchange, the Johannesburg Securities Exchange. The foreign exchange market in itself is a financial market, and so on and so on. Lastly, we have regulators. In Kenya, we have several of them, like the Central Bank of Kenya in charge of the banking sector, the Insurance Regulatory Authority in charge of the insurance sector, the Retirement Benefits Authority in charge of pensions and other retirement schemes, and so on and so on. So that is the financial system. And what does the financial system do? It facilitates risk sharing through things like insurance and diversification. Liquidity, it allows you to convert your assets very quickly into cash. If you have financial assets, you can convert them into cash very easily. It collates a lot of information and therefore is able to make decisions on whom to lend money to, whom not to lend money to. It provides payment services You can pay for goods and services in various ways, courtesy of the financial system. And lastly, it does financial intermediation, channeling money from those people who have excess to those people who have a shortage. So that is the financial system in a nutshell. So in the next lesson, we are going to look at the goals of the firm, and just in case you have any question, please post them in the next class. Thank you very much.